This is Japanese Economic Review Channel.
Hey there.
Welcome to our analytical video breakdown of the newly published Domestic Weekly Outlook. This covers the really crucial upcoming week of July 27th to July 31st, 2026. And, for those of you watching, our mission today is to just really unpack this newly released market data.
Yeah, and it's some heavy data this week.
It really is. I mean, we are looking at a market that is sitting at this fascinating and, frankly, highly precarious crossroads right now.
Oh, absolutely.
So the Nikkei average has officially closed at 64,611.15.
Right.
But behind that specific number, there's just this massive macroeconomic tug-of-war going on.
Yeah, it's really getting pulled in two completely different directions.
Exactly. Like on one side, we have the gravitational pull of a potential AI-driven boom. But then on the other side, we have these really looming shadows of geopolitical tension, plus some very aggressive central bank posturing.
Right.
So we are going to break down exactly how these forces are interacting and, what the official statistics are telling us about the week ahead.
It's just a remarkable moment to be analyzing these figures, honestly, because when you look at the raw data in this week's publication, with the Nikkei closing up 470.03 points at that 64,611 level.
Yeah.
And the TOPIX closing at 411.31. You might initially just see this picture of pure resilience.
Sure, it looks great on the surface.
Right. But the outlook immediately throws cold water on that optimism.
Yeah, it does.
It explicitly points to the worsening situation in the Middle East as like the primary burden capping the markets upside right now.
And it's not just minor diplomatic stuff either.
No, not at all. We aren't looking at isolated incidents. The data shows we are looking at systemic physical threats to global supply lines.
Okay, so let's dig into the mechanics of that, because the geopolitical data we are tracking here is incredibly dense.
Very.
We are seeing that the peace talks between the U.S. and Iran they've essentially stalled out. Completely stalled.
Right. And the immediate ripple effect of that diplomatic failure isn't just political. I mean, it is happening on the water.
Exactly.
The statistics note that Houthi rebels have officially blockaded the Bab el-Mandeb Strait.
Which is a huge deal.
Right. Now, for anyone watching who tracks global logistics, you know that because of the ongoing instability in the Strait of Hormuz, Bab el-Mandeb had actually become the critical alternative route for Saudi oil.
The backup plan.
Yeah, the backup plan. It's like local authorities fixing a major highway detour only to have a boulder immediately crush the detour road too.
That is a great way to put it.
But the friction here is way worse than a traffic jam, right? I mean, the global oil supply routes are just getting entirely choked off.
That is exactly the right way to frame it. And, the mechanics of that chokehold are precisely why the published statistics show oil prices surging again.
Wow.
Because the Bab el-Mandeb Strait is just a vital artery for global energy continuity.
When you close that detour road, as you called it, you fundamentally alter the physical reality of the oil market.
Because the ships can't just sit there.
Exactly. They can't just wait it out. They have to reroute entirely around the Cape of Good Hope down at the southern tip of Africa.
Which adds, like thousands of miles to the journey?
It adds thousands of miles. And crucially, it adds 3 to 4 extra weeks of transit time.
Oh, man, 3 to 4 weeks?
Yeah. And mechanically, think about what that means for the market. It means millions of barrels of oil that were supposed to be delivered this week
are just nowhere to be found.
Right. They are instead sitting on the water, just acting as floating storage.
Wow.
So that causes an immediate severe drop in available supply at global ports. And simultaneously, insurance premiums for these vessels skyrocket due to the war risk.
Sure, that makes sense.
And then the fuel costs to sail that extra distance just multiply. All of that friction instantly translates into higher crude prices.
And for an energy importing powerhouse like Japan, I mean, this isn't just some abstract global issue.
No, it's a direct, immediate tax on corporate margins.
Which leads to a really pressing question for you, Watson, especially if you are holding equities right now. Looking at the official data and the current market levels, has the market actually priced in the absolute worst case scenario here?
Oh.
Like, are we fully pricing in a full-scale U.S.-Iran military conflict, or is the market just pricing in these, shipping delays?
That is the multi-trillion-dollar question right there.
Yeah.
And the outlook actually gives us a very clear answer on this. No.
Really? No.
It explicitly states that this worst-case scenario of a direct full-scale military conflict is not fully priced into the current Nikkei valuation.
Wow. Okay.
Right now, the market is pricing in severe friction, sure, higher shipping costs, longer lead times, but it is still assuming that regional stability won't completely collapse.
So they're still being somewhat optimistic.
Exactly. And this is exactly why the report flags it as a critical shock risk for your portfolio in the upcoming week.
So the geopolitical risk premium is currently too light, basically.
Way too light. If headlines break indicating a hot conflict, the current equity levels have a really significant distance to fall before they find a fundamentally priced floor.
Yikes. And you know, that surge in oil prices isn't just an energy story, though. It is fundamentally an inflation story.
Yes.
And inflation is the exact enemy of the tech sector, which, well, that brings us to the other massive force dragging on the market in this report.
The tech transition.
Right. We are transitioning from geopolitical anxiety directly into technological financial burdens. Because while the Middle East is threatening the cost of energy, the tech sector is facing a massive crisis of capital.
They really are.
The numbers highlight this rapidly growing anxiety over the continuity of the whole AI boom.
Yeah, the headline data point that has everyone on edge right now is Alphabet, Google's parent company,
Right.
announcing a staggering $205 billion capital expenditure plan for 2026 alone.
$205 billion just for 1 year.
Yes, just for 1 year. It is a breathtaking figure.
That's insane.
To put that in perspective, $205 billion in a single year for CapEx is literally larger than the entire market capitalization of many legacy blue-chip corporations.
Wow. And the data shows that the market reacted to this announcement negatively, right? Heavy selling.
Very heavy selling. And we really have to look at the mechanics of why the market panicked here. The underlying fear outlined in the statistics is that hyperscalers—
Those are the massive tech monopolies, right? Google, Microsoft, Amazon.
Exactly, the ones operating cloud infrastructure at a global scale.
Right.
The fear is that they're going to run out of free cash flow because building these AI data centers requires immense capital for advanced semiconductors, liquid cooling systems, and just basic real estate.
Yeah, that infrastructure isn't cheap.
Not at all. So the fear is that to fund these heavy financial burdens, they will be forced into massive stock issuances.
And stock dilution is always the boogeyman for shareholders. Like, if Alphabet has to issue millions of new shares to raise that $205 billion, the slice of the pie for existing shareholders just gets smaller.
Right. Earnings per share drops even if the company is growing.
But wait, here's where it gets really interesting in the report. And I actually want to push back a bit on this market pessimism.
Okay, let's hear it.
Because looking at this objectively, isn't tech still king?
Whoa.
Like, a $205 billion investment sounds to me like a massive, undeniable vote of confidence in AI's future by the smartest people in the room.
It's a fair point.
Right. I mean, they aren't burning this money in a furnace. They are building physical infrastructure. The market is reacting to the sticker shock of $205 billion today. But to me, it seems like in the AI arms race, not spending that money is just a guaranteed death sentence.
Yeah.
So doesn't this expenditure act as a moat, like a huge barrier to entry that basically guarantees these few companies will own the future of computing?
You're touching on a profound contradiction that the data in front of us actually validates.
Oh.
Yeah. The market definitely sold off on the CapEx shock. But the frontline analysts, the people whose entire job is to model the 5 to 10 year cash flows of these technologies.
What were they doing?
They are completely ignoring the recent market dip.
No way.
Yes. The official statistics show that these analysts are actually still raising their target prices for major semiconductor and AI-adjacent stocks.
Wait, they're raising targets despite the sell-off?
Exactly. Why? Because they agree with your assessment. They see that $205 billion, exactly as you described it, as an impenetrable moat.
That makes so much sense.
They are looking past the immediate funding friction, and they're focusing on the projected productivity gains and, honestly, the monopoly power that this infrastructure will eventually yield.
Wow. Okay, so the analysts are buying the vision, but the broader market is just terrified of the immediate price tag.
Precisely.
So how does that tension actually resolve itself in the coming days?
Well, the upcoming week is going to be the absolute proving ground for this thesis. The outlook points to the upcoming April to June corporate earnings reports as the ultimate stress test.
Right, earnings season.
Right. We are looking for the market to transition from a hype-driven valuation model, where, people buy purely based on the promise of AI.
Just the vibes, basically.
Yeah, exactly, vibes. Transitioning from that into what is known in Japan as Joseki Soba.
Ah, kiseki soba, meaning an earnings-driven market.
Exactly.
That's the phase where the fairy tale ends and companies actually have to open their books and prove that their massive AI investments are generating hard, undeniable revenue today.
You hit the nail on the head. It is the shift from buying the dream to buying the cash flow.
Right.
And if we transition smoothly into this earnings-driven phase, and the semiconductor revenue guidance holds up and justifies these massive CapEx plans,
What happens then?
the forecasts in this report indicate that Nikkei could actually target the 70,000 range.
70,000. Wow. That is a massive psychological and technical ceiling for the viewer to keep in mind.
Mm-hmm.
But, to get there, we really have to survive a gauntlet next week.
We do.
Because right now, the market is sitting on a powder keg of geopolitical oil inflation and this AI earnings anxiety.
Mm-hmm.
So what could light the match next week?
Well,
The outlook points directly to the institutions that are hypersensitive to both of those factors, the central banks.
the central banks.
We have dual central bank showdowns that could completely upend the currency markets.
And this is where the macroeconomic mechanics get incredibly delicate.
Mm-hmm.
So first, the FOMC, the U.S. Federal Reserve, is meeting on July 28th and 29th.
Right.
Now we have the new Fed chair, Warsh, who just took office in May.
And he's intense.
Very. The data underscores that he is notoriously hawkish.
Yeah.
And mechanically, a hawkish stance means he prioritizes crushing inflation over stimulating economic growth, usually by keeping interest rates high.
Right. No free money.
Exactly. He has consistently and publicly denied any inflation optimism.
Which is scary for the market.
Very. So even if the Fed decides to just hold rates steady at this specific meeting, his tone during the press conference is the real variable here.
Gotcha.
If he signals that rates must stay elevated indefinitely, to fight off the inflation caused by that Middle East oil shock we discussed earlier,
Yeah.
that tone alone could trigger aggressive risk-off selling across global equities.
Because high yields in the U.S. make riskier assets, like, tech stocks trying to fund $205 billion data centers, look much less attractive to investors.
Exactly. It's all connected.
But it's not just the Fed we have to worry about, right? The Bank of Japan is meeting right after them on July 30th and 31st.
They are.
Now, historically, BOJ meetings can be a bit sleepy.
Yeah, quite often.
And the outlook even mentions it's expected to be a, quote, windless non-event.
Right.
But there's a massive caveat in the data here. The BOJ might be showing flexibility in accelerating rate hikes faster than the anticipated once every 6 months pace.
And that flexibility is the wild card, because you have a hawkish U.S. Fed keeping the pressure on, and a BOJ that might suddenly wake up and accelerate tightening.
Which is a crazy combo.
It is. And we have to view this potential collision through the lens of the current exchange rate.
Right, the yen.
Yes. The numbers have the USDJPY hovering around 163.84.
Which is a 40-year low.
A 40-year low for the yen. And the forecasted volatile range for the week is incredibly wide, from 162.0000 all the way to 165.00.
Okay, let me paint a scenario for the viewer based on these mechanics, because this sounds dangerous.
Go for it.
If the Fed stays aggressively hawkish, which keeps U.S. bond yields high and the dollar strong, and then the BOJ surprises everyone by pulling the trigger on a faster rate hike, couldn't that violently snap the exchange rate back from that 164 level?
Oh, absolutely.
I mean, a sudden, sharp appreciation of the yen would cause utter chaos for Japanese exporters.
Total chaos.
Like companies like automakers and heavy machinery manufacturers, they build their forward earnings guidance on the assumption of a weak yen.
Right, because it inflates the value of their overseas profits when they bring that money back to Japan.
Exactly. So a sudden snapback wipes out those profit margins instantly.
It would be highly disruptive.
Yeah.
And you are highlighting exactly why the Outlook issues a specific formal warning about potential market interventions by the Japanese government.
Oh, so they might actually step in.
Yes. The mechanics of currency intervention are brutal. When you approach that 165.00 threshold, the probability of the Ministry of Finance stepping in with massive yen buying and dollar selling interventions skyrockets.
So it's less like the government gently tapping the brakes to slow down the yen's depreciation, and more like them yanking the emergency brake on the highway to intentionally cause whiplash for currency speculators.
Yeah, that is precisely what it is. Interventions are designed to inflict maximum financial pain on speculators betting against the yen.
Ouch.
Yeah, resulting in violent, unpredictable market reversals.
So it's super dangerous right now.
Extremely. Because of these compounding multi-front shock risks, the geopolitical supply chain break, the tech capex dilution fears, and this central bank collision.
Yeah.
The report officially advises investors to maintain a higher cash position going into this week.
Ah, cash is king.
Exactly. The data suggests this is a time for capital preservation, not aggressive leverage.
Okay, so knowing these massive macro threats, how should you watching actually navigate the specific days of this upcoming week?
It's going to be a busy one.
It is. Because the interactions are what really matter here.
Yes, the timing is everything.
Let's break down the timeline. Tuesday and Wednesday are basically the pressure builders.
Right.
We have the FOMC meeting taking place, and it is colliding head-on with mega-cap tech earnings.
Huge ones.
We are talking Microsoft and Meta in the U.S., and then heavy hitters domestically like Keyence, Hitachi, and Nomura.
The Tuesday and Wednesday timeline is crucial because it sets the narrative for the whole rest of the week. The market will be processing Microsoft and Meta's capex numbers in real time. We will see exactly where those billions are going.
Right.
And investors will be trying to parse those spending habits while simultaneously bracing for the FOMC's hawkish signals.
Sounds stressful.
It is. But Thursday is where the structural integrity of the entire market will truly be tested.
Okay, Thursday is the big day.
Thursday is the crucible.
Yeah.
That is when the BOJ meeting officially begins. And simultaneously, the U.S. drops its Q2 GDP and its PCE data.
Wait, let me just jump in quickly to clarify that for everyone watching. PCE, that's the Personal Consumption Expenditures Index.
Yep.
And that is the Fed's absolute favorite inflation gauge, right?
So one they watch closest, yeah.
Because it is more heavily weighted than the standard CPI, mainly because PCE actually measures what people are spending their money on in real time.
Yeah.
Like, it adjusts when consumers swap out expensive beef for cheaper chicken to save a buck, giving the Fed the most accurate read on actual consumer pain.
That is exactly it. It tracks the reality of consumer behavior.
Right.
And as if all of that macroeconomic data wasn't enough for one day, Thursday is also when earnings from Apple, Amazon, Samsung, and Tokyo Electron all hit the wire.
Wow. It's an absolute traffic jam of market-moving data.
It really is. And this raises an important point about cause and effect. We have to look at the feedback loop here.
Okay, what do you mean?
Well, if the U.S. economic indicators on Thursday, specifically the Q2 GDP and the PCE, come in stronger than expected.
Meaning the economy is doing well.
Right. It proves the U.S. economy is running hot. And mechanically, a hot economy means the Fed absolutely cannot cut rates.
So they say hawkish.
Exactly. That realization could push U.S. bond yields higher, which pulls the dollar even higher against the yen.
Right, towards that 165 mark. Yes.
Directly toward that critical 165.00 mark.
Yeah.
And as we just discussed, hitting 165.00 directly tests the Japanese government's threshold for pulling that emergency brake on currency intervention.
Oh, man.
Right as the DOJ is sitting down to make their policy decision. It is a perfect self-reinforcing loop of macroeconomic tension.
It is a make or break 48 hours. I really want to emphasize the sheer density of Thursday and Friday to you watching this.
It's unprecedented.
You have tech earnings trying to justify a $205 billion infrastructure build-out. You have U.S. inflation data dictating global bond yields. And you have BOJ policy potentially intervening in a 40-year low currency crisis. And all of these forces crash into each other at the exact same time.
It's wild.
And Friday doesn't let up either. We have BOJ Governor Ueda's press conference, which will dictate the yen's trajectory for the rest of the quarter.
Right?
We get the China PMI data, which gives us the health of Asian manufacturing. And we have crucial domestic earnings from Mitsubishi Electric, Murata, and Kioxia.
So when you synthesize all of this data, Friday afternoon will likely look like a completely different market landscape than Monday morning.
It really could.
You have to understand that the interactions between these data points are nonlinear.
What's a good example of that?
Let me give you a grounded example. Let's say Tokyo Electron reports incredible earnings on Thursday, showing massive global semiconductor demand.
Okay, good news.
Normally, that would trigger a huge tech rally. But if Governor Ueda signals aggressive rate hikes on Friday, the yen could instantly spike.
Oh.
For Japanese investors, any equity gains driven by Tokyo Electron could be completely neutralized because the currency appreciation wipes out the foreign exchange advantage on those global earnings.
That's a great point. It just erases the gains.
Exactly. The outlook advises caution precisely because these overlapping events make the final outcomes virtually impossible to model with certainty.
So bringing everything together for the viewer.
Yeah.
The Japanese market is currently standing at a massive crossroads. On one path, we have the optimistic potential of a 70,000 Nikkei, driven by frontline analysts who believe the hyperscalers' massive investments will translate into an undeniable earnings-driven market, that Gaiseki Soba.
Right.
But on the other path, we are facing severe dual threats. A Middle East conflict that is physically choking off the global oil supply and acting as an unpriced shock risk.
Yes.
And central bank surprises from a hawkish Fed and an unpredictable BOJ that could trigger violent currency interventions.
A lot to navigate.
You really have to respect the underlying data advising you to hold a higher cash position while this week shakes out.
It is the only prudent approach when the standard deviations of potential outcomes are this wide.
Yeah.
You are literally balancing the absolute bleeding edge of future AI technology against the oldest geopolitical supply chain risks in the world, all filtered through the most volatile currency market we've seen in 4 decades.
It's incredible. And that actually leads to a final provocative thought to leave you with, something that builds on everything we've unpacked today but requires you to just connect the dots on your own. We spent time talking about tech giants preparing to spend $205 billion a year on massive, sprawling new AI data centers, right?
Right.
At the exact same time, we are watching global energy prices surge because crucial shipping lanes in the Middle East are being physically blockaded.
Yeah, the oil is getting cut off.
So how exactly will the unimaginably massive electricity demands of this new AI boom collide with a global energy supply that is increasingly constrained, volatile, and expensive?
That is the million-dollar question.
It's a collision course between digital ambition and physical reality, and it is going to completely redefine the markets. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.